Is there any correlation between Fed rates, mortgage rate and housing price? September 19, 2024. Yes, there is a significant correlation between Federal Reserve interest rates, mortgage rates, and housing prices, though the relationship is complex and influenced by factors like the broader economy, inflation, and supply and demand. 1. Federal Reserve rates and mortgage rates. The Fed influences, but doesn't directly control, mortgage rates. When the Fed cuts its rates, banks lower mortgage rates, making borrowing cheaper. Conversely, when the Fed raises rates to curb inflation or slow the economy, mortgage rates typically rise. Over the last century, mortgage rates have moved closely with Fed rate changes. 2. Mortgage rates and housing prices. There's often an inverse relationship between mortgage rates and housing prices in the short term. Lower mortgage rates decrease borrowing costs, boosting demand and driving up prices. Higher rates can make borrowing more expensive, cooling the housing market. However, the impact of mortgage rate changes on prices is not always immediate and can take months to show in the housing market. 3. Historical examples. 1950s 1960s, post-World War II growth led to stable housing prices, even with fluctuating mortgage rates. 1980s, high inflation and Fed rate hikes pushed mortgage rates to 18%, reducing affordability and causing housing price stagnation. 2000s, low mortgage rates contributed to the housing bubble, leading to the 2008 financial crisis when housing prices collapsed. Post-2008, the Fed's rate cuts helped the housing market recover, with prices rising steadily. COVID-19 pandemic, record low mortgage rates combined with high demand caused a sharp rise in housing prices, especially in suburban areas. 4. Other factors. Supply and demand. Even when mortgage rates are low, housing prices may rise due to supply shortages. Inflation. Higher Fed rates typically raise mortgage rates, but housing prices may still increase as a hedge against inflation. Government policies, incentives, subsidies, and government-backed loans can influence housing demand and prices. Key takeaways. Fed rates and mortgage rates. Mortgage rates follow Fed rate changes with a lag. Mortgage rates and housing prices. Lower mortgage rates generally drive prices up, while higher rates cool the market. Decoupling. Housing prices can rise despite higher mortgage rates due to factors like supply shortages and inflation. In conclusion, while Fed rates, mortgage rates, and housing prices are strongly correlated, other factors like supply and demand and government policies play crucial roles in the housing market.